For years, AI investing meant betting on a handful of tech giants. Investors flocked to the familiar names, companies that built the algorithms, designed the chips, and dominated the headlines. The focus was on innovation at the software level, and the world watched as these tech titans soared to new heights. But in 2026, BlackRock is rewriting the playbook. The financial powerhouse is challenging conventional wisdom, urging investors to look deeper and think differently about where the real opportunities lie. The world's largest asset manager, overseeing $13 trillion, is shifting focus from the creators of AI to the companies powering it, literally. It's a strategic pivot that recognizes the unseen backbone supporting the digital revolution. The new gold rush isn't just about algorithms, it's about the infrastructure, electricity, power grids, and data centers that makes AI possible. These are the unsung heroes, quietly enabling the explosive growth of artificial intelligence. AI is a physical force demanding immense real-world resources. Every breakthrough in machine learning or generative AI increases the strain on our energy systems and the need for robust, scalable infrastructure. Every AI query and calculation consumes significant electricity in massive, purpose-built facilities. These data centers are the beating heart of the AI era, drawing power on a scale that rivals small cities. As demand for AI accelerates, so does the need for power and infrastructure. The race is on to build, expand, and modernize the networks that keep AI running 24/7. BlackRock urges investors to look beyond software to the supply chain that keeps AI running. From raw materials to logistics, every link in the chain is now a potential source of value. The next wave of AI wealth will be built on concrete, copper, and kilowatts. These are the building blocks of tomorrow's digital economy and the foundation for the next generation of innovation. The map to AI riches now points to energy and infrastructure, the true foundation of the revolution. In this new era, those who invest in the backbone of AI may find themselves ahead of the curve, shaping the future from the ground up. BlackRock's recent survey of institutional clients reveals a dramatic shift in how the world's largest investors are thinking about artificial intelligence and its future. For years, the focus was on the tech giants, companies that built the software and platforms powering the AI revolution. But now, the tide is turning. Over half of these institutional investors now see power providers, those generating and delivering the electricity that AI needs, as the top AI investment opportunity. This marks a significant change in priorities, as the energy demands of AI become impossible to ignore. Infrastructure firms, including the builders of data centers and the companies expanding power grids, are close behind, favored by 37% of investors. These firms are laying the physical foundation for the AI era, making them increasingly attractive. In contrast, only 20% of respondents still view the largest US tech groups as the best bet for AI investment. The dominance of the tech titans is being challenged as investors look beyond software and algorithms. The so-called Magnificent Seven are no longer the only game in town. Investors are diversifying, seeking new ways to benefit from the AI boom. This isn't a loss of faith in AI itself, but rather a more sophisticated approach. Investors want exposure to the essential tangible assets, like energy infrastructure and data centers, that are truly driving the AI boom forward. Only 7% believe AI is a bubble, showing deep conviction in its future. The vast majority see AI as a long-term force that will reshape industries and economies. The smart money is moving from hype to the hardware, infrastructure, and energy that make AI possible, signaling a new era in investment strategy. The pivot is simple. AI's digital magic relies on a massive physical backbone. As AI models grow, so do their demands for hardware, electricity, and construction. Tech giants are pouring trillions into global data centers, but the costs and risks are rising. Investors now see more predictable returns in the companies supplying energy and infrastructure. These firms don't care which AI model wins. They profit as long as the industry grows. Power grids, renewable energy, and constant data center construction are now essential. Betting on these sectors means riding the AI wave with less volatility. The real winners? Those who supply the picks and shovels for the digital gold rush. AI's hunger for electricity is staggering. Training large models requires constant, massive power. Data centers now consume as much energy as small cities, making energy providers central to AI's future. Power costs are now a critical factor for every AI venture. Utilities and renewable energy developers have become indispensable partners in the AI ecosystem. Every new data center means more business for energy companies, especially those leading the green transition. Tech giants' push for 100% renewable energy is fueling a boom in solar, wind, and geothermal projects. For investors, energy is no longer a side bet. It's at the heart of the AI revolution. AI's growth is driving a historic boom in physical infrastructure. Data centers, complex, secure, and power-hungry, are the new battleground. Infrastructure companies are building the backbone. Advanced cooling, redundant power, and specialized equipment. The demand isn't just for more data centers, but for smarter, more efficient ones. Upgrading power grids and building new transmission lines is now essential. BlackRock, Microsoft, and NVIDIA's $100 billion joint investment in data centers and power infrastructure shows the scale of opportunity. Investing in these enablers offers exposure to AI with more stable, predictable returns. The foundation of AI's future is being laid in steel and silicon, not just code. The dominance of mega-cap tech stocks has created risky concentration in portfolios. Just a handful of companies now account for 40% of the S&P 500's value. Any stumble by these giants could shake the entire market. Investors are diversifying into energy and infrastructure to hedge against tech volatility. These sectors offer more reasonable valuations and steady, essential revenue. The shift is from chasing momentum to investing in fundamentals. By reallocating capital, investors can ride the AI megatrend while reducing risk. Diversification is the new mantra for AI investing in 2026. With interest rates set to fall, investors are seeking growth beyond cash and traditional portfolios. True diversification means finding assets with different risk drivers, like utilities and construction firms powering AI. These companies offer stable, long-term returns, balancing tech's volatility. BlackRock urges investors to dig deeper, targeting unique enablers of AI growth. The strategy handpick power companies, engineering firms, and renewable developers poised for sustainable gains. By diversifying into these sectors, investors build resilience and capture the full potential of the AI revolution. It's a shift from betting on innovation alone to investing in the enduring needs of a tech-driven world. BlackRock's 2026 playbook is clear. Move from broad, passive AI bets to a targeted, active strategy. The first wave was about buying big tech. The next is about understanding the entire value chain. BlackRock's AI-focused ETF, BAI, now actively shifts capital into energy, semiconductors, and infrastructure. The advice: diversify portfolios to include meaningful exposure to these sectors, not just tech. Own a piece of the whole ecosystem, from chip designers to utility providers. Success in AI isn't zero-sum. Value will be created across many industries. Think like a business analyst. Who supplies the power, builds the facilities, and maintains the grid. The winning strategy: be precise, be diversified, and invest in the entire AI ecosystem. The future of AI investing is about looking beyond the obvious. While many are captivated by the rapid advances in AI software and algorithms, the real lasting value may lie elsewhere. The focus is shifting from the brains of AI to its body, the energy and infrastructure that sustain it. Every AI breakthrough relies on vast networks of data centers, robust power grids, and reliable sources of energy. Investors should research utility companies, renewable energy developers, and engineering firms specializing in data centers. These sectors are quietly becoming the backbone of the AI revolution, providing the essential resources that make AI possible. These businesses will see steady demand as AI expands, regardless of which tech company leads. The need for more computing power and clean energy will only grow as AI becomes more integrated into daily life and business operations. Diversification is now an offensive strategy to capture AI's full potential. By spreading investments across infrastructure, utilities, and renewables, investors can position themselves to benefit from multiple angles of AI's growth. Rebalance portfolios to include energy and infrastructure, either directly or through specialized ETFs. This approach helps manage risk while tapping into the foundational growth supporting AI's expansion. The AI build-out is a multi-decade project. Foundational investments will deliver the most durable returns. Infrastructure and energy are long-term plays that can outlast short-term tech trends. By focusing on the essential needs of AI, investors can benefit from both today's innovation and tomorrow's enduring infrastructure, ensuring their portfolios are built for the future.